So without a recovery in housing, what are the chances of a self-sustaining economy? And what about market leadership? Can Apple just continue to increase in value, pulling the NASDAQ along? For more, I'm joined now by Walter Todd. He is the Chief Investment Officer at Greenwood Capital, where he helps manage $950 million worth of client assets. And you're based in Greenwood, South Carolina. Walter, it's a pleasure to have you here in New York.
Glad to be here.
So tell me about this two contrasts, because I mentioned Apple, right? And this is a stock that has really pulled the NASDAQ higher. And if you look at what's happened to the stock market, the NASDAQ particularly, it's a story of Apple, right? On the other hand, you take a look at the housing market, and as Deborah was saying, it's okay, but it's not great right now.
Correct. I mean, if you look at Apple, it's kind of, you could say it's an asset class in and of itself. You got stocks, bonds, and Apple.
I like that. Stocks, bonds, and Apple.
So, you know, it's 20% of the NASDAQ 100. It's about 7% of Russell 1000 growth, which is the index we look at. So, really, it has exorbitantly taken the indexes higher with up 45% year to date. So, if you pull that out of a lot of statistics, whether it be earnings growth, whether it be price performance, you get a very different picture of the market and the backdrop. And as you say, housing, we think it has hit bottom. It is not going to be a robust recovery, but the fact that it's not going to be a detractor from the economy for the first time in 5 years, we think it is actually a plus.
But is that going to be enough for policymakers? I mean, you think that the Federal Reserve Chairman Ben Bernanke is going to say, all right, he heard Walter Todd speak, maybe housing has bottomed, but housing's such a big factor in the economy, not only just the house, but everything that goes in the house.
Sure, it is. There's no question about that. But if you look at this year versus 2011, 2010, I think there's some important differences. One, look at all the other countries easing monetary policy.
Right, we were alone back then, right?
We were alone back then. Actually, you had Trichet raising rates April this time last year, believe it or not. It was a bonehead move by him, but nevertheless, he did it. So very different backdrop from a monetary standpoint. And if you look at the action in the housing stocks, you mentioned Home Depot at the opening.
Yeah, up 0.8%. Also, Lowe's moving higher by the same amount.
Home builders, et cetera. They're telling a little bit of a different story. The National Association of Home Builders Sentiment Index, still very depressed on an absolute level. From a high of 70, it's at 28, but that's up off of a level of 10 or 12. So we think we're moving in the right direction. Let me be the first to say that I think the market's due for a little bit of a breather here, but I do think there are some important differences between this year and 11 and 10.
Okay, so if the market is going to take a little bit of a breather, maybe we're going to have some kind of pullback just because people might take profits. Right. What kinds of stocks are you looking at? I was looking at a list of the things you follow. CBS, Kraft, Schlumberger. These are mammoth companies.
Yeah, we have a large cap strategy and a mid cap strategy, focusing on the large cap right now. I think there are opportunities across sectors. I mean, you've seen financials be a leadership sector for the first time in quite some time. We think that can continue with a steepening yield curve and the stress test behind you. But I also think you can look in defensive sectors, so you can kind of do a barbell. You can look at industrials, technology, financials, more cyclically oriented sectors, but you can find opportunities within consumer staples and within healthcare as well. So we think you can build a very diversified portfolio that even if you get a market pullback, you're going to have some give and take in that portfolio and have some winners as the market pulls back as well.
What do you think the chances are that we don't get this big pullback that everyone's been talking about, so no one gets to get in for the cheap? I mean, what about if we only get a pullback of maybe 2 or 3% and the market goes higher? We've seen that before.
We have. It's rare, but if you look at 1995 as an example, that the market undeniably went straight up, had the maximum of a 2% pullback that entire year, ended up 34% for the year. So that is a risk to the upside, and the fact that you have so much money on the sidelines, it's well documented that hedge funds have not really participated in this market move. So that is a risk for a continued melt up higher in stocks, and one that you have to take account of. But again, I would say that we think we're due for a little bit of a correction or at least a pause right now, given the risks that are still out there in the marketplace.
We've got more, but what if the Treasury market continues to sell off? People take a look at their portfolios. They say, you know what, my principal, it really can get eaten away if people sell bonds. Maybe they're going to put more money in stocks?
Right. I think if you get that statement and your bond portfolio, your safe haven asset is actually in negative territory, and you've got stocks up 12 to 15%, you start to reevaluate your asset allocation at that point.
Also with us, Neil Dutta, economist at Bank of America Merrill Lynch Global Research, and Joe McAlinden, Chairman and Chief Investment Officer, Catalpa Capital. All right, Neil, tell me about what's going on in the economy. And you've been telling me that things are not going to be great in the second half of the year for the U.S. economy, right?
That's right. I mean, I think the growth bulls have a lot of explaining to do, Pimm. Gas prices are up. We know that foreclosures are going to begin to pick up over the course of the year. And, they want us to believe that, people are inherently not forward-looking and can't see this massive fiscal cliff, as Ben Bernanke talked about in 2013. I mean, they would have you believe that all the hit comes when the austerity itself actually goes into place. My view is that, people are forward-looking. It's a bit like arguing that you don't board your home in anticipation for a hurricane, or you drive fast when there's a dense fog on the road. When uncertainty looms, people get cautious, businesses get cautious, and I think growth is going to slow in the second half of the year. It's not discounted in the current price action, obviously, in the stock market, but I think that's going to probably change.
Joe McAlinden, do you think this is going to change you? I mean, you've been a bear. Never. I scared you there, right?
Yeah, well, actually, we were talking before the show that with some of our interesting conversations in the next couple of years, maybe as we get more cautious, but the caution that I see looming on the horizon, and we're not there yet, I still think market goes higher, is because I believe the economy is going to be far stronger than people think, beginning in the second half of the year, and continuing
He's looking at you, Neil. Go ahead, yeah.
Continuing into 2013, driven by the thing that usually leads the economy out. This time it's going to be jumping onto an economy that's already growing 2.5% per year, and that's housing. And that's going to raise fears of an earlier than expected tightening and inflation concerns greater than we have now, and probably push up bond yields to 5-6%. That's when I'm going to start turning bearish. I see that coming, but I think we're far enough away from that you still want to be long common stocks.
All right. Earlier today, I spoke to David Crow. He's the economist of the National Association of Home Builders, and we talked about this whole issue of about 10 million units that are out there, 6.5 million in shadow inventory, maybe another 4 million in the foreclosure pipeline. He mentioned something interesting. He said, but those are concentrated in specific geographic areas. Don't get hung up on all of this housing inventory that's going to get into the market. Do you agree with that?
I do, and it's not just geographic, but it's price points. A lot of that shadow inventory is in homes that are priced at around $125,000. When you look up the curve at higher price points, the shadow inventory is almost zero. And that's not my numbers, it's right from CoreLogic, which is the source of a lot of this data. And so I think you may have initially a bifurcation where the low end remains weak and the higher end starts to face somewhat of a shortage.
Neil, what do you think about that? The low end stays weak, the high end faces a shortage, and I keep hearing, for example, that a lot of young people, they don't necessarily want to buy a house, not because they're worried about house prices going down, but because they can stay home and live with their parents, and they've got free internet, laundry, and food. What's not to like?
Well, I mean, I think if you look at things like the mobility rate, the people moving within the country, it's at a record low. It's never been as low today as ever before. Doubling up of households. Kids living with their parents. That's never been higher than ever before. And that means, this is what happens after a recession. It takes time to clear out the dead wood. It takes time for resources to reallocate. And there was a massive misallocation of resources between 2002 and 2008. And this takes time. And so, and that means ultimately, Pimm, potential GDP in this country is slowing. People can't go to where the jobs are. They have to sell their home. They're going to try to recoup some of the losses because so many people are negative equity. You have a lot of older people staying in the workforce longer. That's keeping the younger people from coming in. So, I think potential GDP is slowing. Productivity is probably coming down. That's really what the economic data, broadly speaking, is showing. You have employment rising quite sharply, but if you look at a lot of the indicators that go into GDP, that's coming down. So productivity is slowing, and I think you're going to need to see significantly stronger economic growth, 4 or 5%, to sustain this kind of employment growth, and I just don't think that's likely.
Walter, Todd, I'm not leaving you out here, but I just wanted you to absorb both of these positions, because Neil says it's going to take time. But there's been a recent survey that says that if you look at the retiree plans, the pension plans of the S&P 500 companies, the average age to retirement is about 9 years. People don't have time, and they can't take 2.5% in fixed income. Do you buy what Neil is saying? And if you do, where do you put your money? Or are you voting with Joe McAlinden and are you buying stocks?
I probably fall in between the two.
All right,
a
little bit of each.
A little bit of each, because a lot of people are calling for this stair step down in growth. We had a stair step up last year, stair step down, as has been said. We think growth is going to be a little bit more steady, a little bit stronger, as was indicated here. So I think there's some commonality between the two. I think one of the interesting things to think about with retirement is people are living longer. If I retire at 65, as you say, I can't afford to go into fixed income and start withdrawing money. I have to put some money in stocks to get the hope of growth. So I think there's this asset allocation shift that people think is going to come out of stocks. We actually think it's going to have to stay in stocks in order to get the potential growth going forward.
And Joe McAlinden, that hasn't happened, right? Because the flow of funds has consistently been into bond funds, not domestic stock funds. You think that flow is going to change?
I do, and it's not going to change just because people want to own stocks or think they ought to, but rather money chases performance, and bonds have been in a 20-year bull market. We've gone through a difficult dozen years in the stock market with high volatility and really no forward momentum for price-wise, and extremely low nominal total returns, virtually zero inflation-adjusted total returns. I think all that's going to change, and as we break through into new highs, as I believe we will this year, we're just not very far from a new high on the Dow, which I think will happen in the next few months. That will generate headlines that begins to bring people back into common stocks, and then it feeds on itself.
All right, we're going to continue the conversation. I like that. Money chases performance. That sounds like a good Wall Street adage. And it's true.
Unfortunately, it's true.
All right, Nobel Prize winner Martin Feldstein of Harvard University says the risks of dramatic tax increases and an economic downturn next year could affect the behavior of businesses and households today. So what does this mean for your money? We're here with our Taking Stock think tank. We have Walter Todd, Chief Investment Officer, Greenwood Capital, based in Greenwood, South Carolina, managing $950 million. Also with us, Neil Dutta, U.S. economist at Bank of America Merrill Lynch Global Research, and Joe McAlinden, Chairman, Chief Investment Officer at Catalpa Capital. So, Joe, what do you think? Taxes, if nothing is done, the Bush-era tax cuts, they go away December the 31st, 2012. If that happens, what do you think is going to happen to the federal budget deficit?
Well, if the tax cuts go away.
Yeah, if the tax cuts go away.
They're going to raise taxes,
That's right.
So the budget deficit should get smaller than we think it's going to be. But if, as Feldstein would argue, it slows down the economy, then it would be cancel itself out. And in fact, historically, that's a lot of what has happened, unfortunately, in both directions. I respect many of my supply-sider friends' views, but the fact of the matter is that in the long run, we're all just better off having our own money to spend rather than having the government spend it for us. And if we get this, in effect, tax hike, it's going to be an issue which could temper my enthusiasm for the stock market.
Walter, what do you think?
Well, it's amazing to me that if you go back through time, the absolute level we've collected in taxes has ranged between 18 and 20% of GDP, regardless of the marginal tax rate. It's a very simple concept that politicians don't seem to understand. As Joe said, they think if they raise taxes, they're going to get more income, but they're going to shrink the GDP and therefore get the same or less income. That's just a empirical fact if you look at the numbers. So, again, I don't see the impetus to raise taxes to solve the deficit problem. It just doesn't make sense to me.
Yeah, but that's what's going to happen unless there's some kind of congressional action, right? And we're in an election year.
Correct. And so I think if the dynamic of Obama being reelected, which looks more likely by the day, and a Republican Congress, House and Senate, I think is probably a good dynamic to maybe help something get done with versus the last term that we've had.
Neil, you think this can happen? I mean, let's say we have to wait until the November election. I mean, that's a short period of time to get something done in Washington, right?
Oh, absolutely.
That's like a month and a half.
I mean, it casts a very wide uncertainty net. I frankly think that if you had a re-election of the president and GOP House and Senate, that would be probably one of the worst markets outcomes imaginable.
Why?
Because gridlock, as has been disproven to be good over the last year and a half. It is not a good thing. What you need is a unified government, and that would potentially offset a lot of the fiscal tightening that we've seen, and maybe put in a long-run deficit package that puts a long-run plan in place to deal with a long-run problem. Going back to this question
you keep talking about the long run. You've been talking about having patience. I mean, come on, do we really have that long to make any changes to what's been going on in Washington? Because, aren't we going to have to raise the debt ceiling?
We are, but remember that what is the fundamental problem in terms of the deficit and debt in the United States? It is basically an entitlement issue, right? The reason revenues to GDP are so low right now is because the economy is fundamentally soft. What we need is a long-run plan. That means some confluence of the following things: an entitlement reform package that raises the retirement age, means test benefits. That's going to happen. Yes, we will have to raise taxes, and we can do it in a way that doesn't necessarily mean that rates go up. You can close loopholes, create efficiency, broaden the base, basically have more people paying taxes, but not necessarily at higher rates. And, you can probably look at the defense budget. These are all the kinds of things that would have to happen in order to put the U.S. back on a long-run debt sustainability plan. And you know what? I think the important thing is that this is entirely feasible, right? We're doing it to ourselves. This is entirely feasible. Everybody knows that. And we might as well do it. But I don't think the political will is there right now.
Joe McAlinden, I'm going to take a little bit of the optimism from Neil, cast it to you and say, all right, let's say this does happen. Stocks continue to go higher because people get the sense that policymakers and lawmakers are going to do something about this?
Well, I think stocks continue to go higher, but I think the issue would be that if we get the Obama second term and a Republican Congress, you have divided government. I actually think that's a good thing. Government that governs least governs best. The key then shifts down to the other part of Washington, to the Fed, where as long as they have the pedal to the metal, stocks go higher.
I want to leave it there. Thank you very much. Joe McAlinden joining us from Catalpa Capital. I want to thank you, Walter Todd from Greenwood Capital, Neil Dutta joining us from Bank of America, Merrill Lynch Global Research.